In this video, I'm going to help you identify 5 mistakes that I see S Corp owners make, unfortunately, all the time if they're self-preparing their tax return or if they're having someone else prepare their return who is not abreast of all these things. And all 5 of these things that I'm going to mention here shortly can either save you money if you do these things properly, meaning save you money in taxes, or at a bare minimum, help you avoid an audit or at least an inquiry from the IRS. So I think it's pretty important that you kind of listen in on this if you're running your business as an S corporation, okay? I won't keep you in suspense. Let me kind of identify these 5 items for you or list them, and then we'll go into the details about each one, okay? The first one is you're not using an accountable plan. An accountable plan is something that if you're an S Corp owner, you should be using to reimburse yourself for costs that you incur as an individual. So what I mean by this is home office, cell phone, internet, maybe the mileage on your vehicle. All of these need to be reimbursed to you via an accountable plan. And this is something that the IRS actually says you need to do. It's not something that I'm just making up, okay? The second thing is paying yourself a reasonable compensation via payroll. You might have heard about that before. We're gonna talk about it a little bit. The third, taking that one step further, is okay, maybe you have reasonable compensation paid via payroll, but what about health insurance premiums and health savings account contributions? Are you integrating that with your payroll? If not, it's going to cost you about 15% in taxes. Again, I'll explain via an example here in a second. The fourth mistake I see occurring is you're not completing certain schedules when you file your S Corp return or preparing the S Corp return. And when I say you, it could be you if you're self-preparing or a tax professional that you've hired, okay? These are like the Schedule M2 in particular, although it's not required to be completed in some instances. I think you should, and again, I'll explain why in a second. And the fifth thing is you're not tracking something called basis. It's now basically a requirement to sort of track this. You should be tracking this. And now the IRS is sort of cracking down. They want to look at this and see if you're doing things properly. So again, those are the 5 items we're going to touch on, and we'll hit those in just a moment. But let me quickly introduce myself. If it's your first time watching, my name is Navi Miraj. I'm a CPA who produces content all over social media to help you save money in taxes. Usually we're talking about tax strategies, and we're going to hit on 1 or 2 strategies in this video. But a lot of times it's to help you save thousands of dollars in taxes, okay? So with that said, let's kind of jump into the actual content. So the first one I mentioned is this accountable plan thing. You may not have heard this before. It's not really talked about in blogs or other YouTubers or folks creating content on social media. And the reason for that is it's sort of like a boring topic, right? But let me help you identify what an accountable plan is. Basically, if you run an S corporation, right? If you are the officer in a S corporation, then you need to be thinking about yourself as a separate entity than your business. So it's you, the individual, the employee, and then there's your S Corp, 2 separate entities, okay? To use an analogy, this would be you, the employee, working for Google, okay? 2 separate entities. And so there are certain expenses that you should be running through an accountable plan. Let me give you an idea. I kind of refer to these as the big 4. This would be home office deduction, perhaps mileage for your vehicle or actual expenses for your vehicle if you're not using the mileage method. Internet, right? You're all connected to the internet via your home and your home office. You are going to want to reimburse yourself for some of those expenses, right? And also your cell phone. Let's say you use your personal cell phone for business and personal reasons, meaning like you don't have a phone strictly for business. Then all of those 4 things I mentioned have a personal element to them and a business element to them. And so what you want to do is you want to have an accountable plan, and you need to complete this accountable plan each month to determine what the business use percentage is business use percentage is of all those costs, right? Let's use a simple one. Let's use home office, okay? Let's say 10% of your home is used for business use. then you would complete sort of the accountable plan to determine, okay, well, what is 10% of the interest I pay on my mortgage, 10% on an HOA fee, 10% on utilities, 10% of your property taxes. Okay, all of these are expenses that you can reimburse yourself for. And so what would happen is you, the employee of your business, would sort of submit this accountable plan, this expense report to the S Corporation. The S Corporation would then reimburse you for those expenses. Okay, so it's a tax deduction to your S Corporation, and then you as an employee receive the reimbursements totally tax-free. Okay, so there's some tax reasons why you want to do it. It's also the proper way. The IRS makes you do it this way. Again, it's not something I just made up. It's the way it's supposed to be happening. Okay, so that's the first thing I identify that most S Corp owners aren't doing properly. The second one is paying yourself a reasonable compensation. You may have heard of this before, but if you're not, let me help you identify. If you're not aware of this, let me help you identify it. So if you look here on my screen, I have the 1120S, right? And so over here where it says compensation of officers, if you're working in your business and you are an employee of your business, then if that is a big fat zero or there's nothing written there, then that's a way the IRS can easily identify that you're not paying yourself anything, let alone a reasonable compensation. And so this is problematic, especially when line 21 shows the IRS that, hey, this business actually made a profit and there's an officer that's not taking a reasonable compensation for services that they provided. Okay, so again, that's problematic. If you're a tax preparer like or a CPA watching this video, then don't hound me too much. There are some small instances, they're not very common, where you may not have to pay yourself a reasonable compensation. But I would say this: if your business is profitable and you are distributing profits from your business to yourself, you need to be paying yourself a compensation there. The reason why this is, right, it's important to know the why behind this, is because basically the IRS and the state want their fair share of the payroll taxes. Payroll taxes are Social Security taxes, Medicare taxes, state unemployment insurance, and federal unemployment insurance. So if you're not running things through payroll, then those reports are not being filed and those taxes are not being paid. And that's why the IRS comes after you if you're not doing that. It's because you're supposed to be paying those taxes and you're supposed to be paying them throughout the year as you're earning this income and paying yourself this reasonable salary. Okay. Number three kind of coincides with number two. Okay, let's say you are paying yourself a reasonable compensation. If you have health insurance, and specifically, I mean health insurance that you're paying for out of pocket. So I'm not talking about where you might have a spouse and that spouse works for a large company and you're on that healthcare plan. I'm talking about maybe you pay for healthcare via the healthcare marketplace, or you have some sort of third-party health insurance. Those health insurance premiums need to be integrated into your payroll. Additionally, if you have a health savings account or HSA and you're contributing into that, you need to integrate all of this within your payroll. Let me explain in an example of how this saves you money in taxes, okay? And how doing it wrong is actually hurting you and costing you money. So let me use my phone here and we'll do a calculation together. So let's say your health insurance premiums are $800 for each month. This could be medical, dental, vision insurance, okay? So that's $800 a month times 12 gets us $9,600 in health insurance premiums that you paid. And let's also say, in addition, you've decided to pay or contribute to an HSA, the health savings account. So that's, let's say, another $7,200, okay? So that's $16,800 in health insurance premiums and HSA contributions that you're making. Well, if you're not running that through payroll and doing that properly, you can overpay by 15.3%. Where I'm getting that number is that's the Social Security and Medicare taxes for you, the employee, and the employer. So that's $2,570 that you're overpaying in Social Security and Medicare taxes because you're not integrating this and you're not doing it properly as part of your payroll, okay? Again, the purpose of this video, not to teach you how to do those things, but at least make you aware of them so that you're not overpaying, or perhaps you need to fire yourself if you're preparing your own taxes, or fire your tax preparer if they're not educating you about these things and how they can save you money in additional tax. Number 4, you're not completing certain schedules on your tax return. So I'll show you these schedules here in a second, but Schedule L, Schedule M1, Schedule M2. Again, if you're not a tax preparer, you may not know what those schedules are, and that's okay. But the point I want to make is this. There are instances where you are not required to complete those schedules. And let me just show you what those schedules are. So Schedule L is basically a balance sheet. So what are the assets of your business? What are the liabilities? What are the equity? Many of you are leaving this blank, and you're allowed to in certain instances. Again, when your assets are below a certain amount and your revenue is below a certain amount, the IRS says you don't have to, but you should be. If you don't know what the assets and liability and equity is in your company at the end of the year, that's a problem, and that could indicate to the IRS that, hey, they left this blank because they actually don't know themselves, okay? I'll get off that one because it's not as big of a deal as, in my opinion, these other schedules are. Schedule M1 and Schedule M2. I'm gonna pick on Schedule M2 for a moment here. If this is blank, in my view, it's problematic. Again, there are some instances where you don't have to complete this, but I would argue that if this is blank and you're self-preparing your return, or you're having a tax preparer prepare your return and these items are blank, you're probably doing things incorrectly because you're not aware, specifically with Schedule M2 here, I'll zoom in a little bit, you're not aware of what's called the accumulated, what the balance is in the accumulated adjustments account. That's a fancy way of saying you're not tracking the profitability of your business and how much of that profit you've extracted from your business. And the problem with that is you might be taking distributions from your business without telling the IRS that you're taking distributions. That's a problem. Or you might be taking distributions in excess of what's called basis. And I'll talk about what basis is here in a second. So what basis is you could refer to it or think of it as skin in the game, okay? Let's talk about some reasons how basis is created. Basis is created when, let's say you first form your business and you contribute $10,000 of money from your personal account into the business account, okay? That's creating basis. That's creating equity in your company. Another way you could do that is, let's say in a future year, you've had to do that same thing. You've had to fund the S corporation. The money that you put in from your personal account to your business account that's called a shareholder contribution, and that creates basis. Another way you could create basis is just by operating your business. So if you make revenue and you have expenses, and at the end of all that, you know, where your revenue minus expenses creates a profit, the profit in your business creates basis, okay? These are all things that create basis. So let's talk about something that doesn't create basis, which I think a lot of people had during the pandemic, right? During COVID. So if you get a loan, specifically, I'm talking about an emergency injury disaster loan, an EIDL, that, you know, the SBA was kind of giving away, quite frankly, during COVID. You could have received that loan. That loan would have been in the name of your business. Let's say it was for $50,000. So now you got $50,000 of cash sitting in your bank account, right? If you distribute that to yourself individually, right? If you take it from your business account and you put it in your personal account, that's a distribution. And it's called a distribution in excess of basis, meaning like if you didn't have enough basis and you took that distribution and that distribution caused you to either decrease your basis to zero, or it was a distribution where it was in excess of any basis that you created in your company, that's actually a taxable event. And you have to pay capital gain tax on that. So my point is this, I know I kind of got into the weeds there with it. If this is blank, that tells me that you're not tracking basis and your tax preparer is not. And don't be surprised if one day you get a letter from the IRS or an audit from the IRS because you left these items blank. You did not inform the IRS of what was going on. Point is, you should be keeping track of these things and completing these schedules. At a bare minimum, you should know what the numbers are. And if you're not required to tell the IRS because you meet the requirements of not having enough assets or not having enough revenue in your business, then know what your numbers are, but then elect to not show the IRS that information. But you should know what those numbers are, okay? So anyway, those were the 5 reasons, right? I'll just recap them real quick. You're not using an and you have an S Corp. You're not paying yourself reasonable compensation. You're not integrating your health insurance premiums or your HSA contributions in your payroll. You're not completing some of these schedules. Specifically, Schedule M2 is one that you probably should be, tracking. And you're not tracking basis. There's actually a form, it's called Form 7203, that needs to be included in your individual tax return when you've taken distributions from your company. And if you're not including that form, that's problematic. Don't be surprised when you get a letter from the IRS. You might have read in the news that the Fed is giving a lot of funding to the IRS, and they're going to use that funding to crack down on partnerships and S corporations that are not doing things properly. Okay? With that said, let me leave you with something else. I hope you learned something. Maybe I taught you something that's going to save you thousands in terms of the Social Security and Medicare tax. On my website, you can go to it. It's navimuradcpa.com. And here, I'll pull it up for you right here. And there is a course that I created to help teach you all these things. So in this course, you will learn, you can watch this video about what you'll learn here, but you will learn what an accountable plan is, how it works, how to reimburse yourself properly. You'll learn a little bit about reasonable compensation, how to integrate your health insurance premiums in payroll, how to keep track of not just your profit and loss, but your balance sheet. And, so that you have the values that you can enter in the Schedule L and the Schedule M1 and M2, okay? How to track your basis and all that stuff. So again, you can see here, there's tons of stuff in here, over 11 hours of content. Check it out. There is a huge coupon code right now during tax season. So if I scared you, if you saw the price here, that's actually the full-blown price. If you elect to use the coupon code, it's super affordable. It's over 60% off, okay? With that said, I'll leave you with that. Hope you learned something, and hopefully it's something that you're gonna correct if you yourself were making these errors, or you're paying a tax professional to do these things for you, and they're making the errors. You should probably find another tax professional. So with that said, I'll see you in a future video.